So, welcome to chapter 3. We're going to go over the adjusting process. And this is all the journal entries that we need to make at the end of the month to accrue for things that have happened during the month that maybe didn't involve cash or things that sort of are earned by the business through the passage of time. And so we have, as part of the learning objectives, we're going to learn the nature of the adjusting process, the journal entries for accruals, deferrals, and depreciation, which are the three types of adjusting entries, and summarize the adjusting process, prepare an adjusted trial balance, and then take a look at vertical analysis of a company's performance. Last week, we looked at horizontal analysis, which is comparing the same company and what changed year over year. Vertical analysis is taking each of the line items on a financial statement and calculating it as a total of total revenue for the income statement or total assets for the balance sheet. And then that allows us to take a look at profit margins and what's contributing to the profit margins of the business. If things are changing year over year, like why are the margins changing? Is it because wages expense went up? Is it because depreciation went up? And sort of taking a more in-depth analysis on that. And then that also allows us to compare financial statements between companies that are of different size or different currency by just taking it as a percentage of revenue so that we can compare different size companies. The nature of the adjusting process before the financial statements can be prepared, the unadjusted trial balance needs to be adjusted for things that happened during the period. During the period, the transactions we've been recording last week in the journal entries was things that happen every day. So earning revenue on account and sending the bills to customers in the normal billing cycle of the month, collecting cash from those customers, paying for wages expense, paying for supplies, purchasing inventory. These are all things that just sort of kind of happen in the regular business transactions during the month. And those entries will be recorded as we go during the period by the automated accounting software or by the bookkeeper or the other people on the accounting team. At the end of the period, we have a number of adjustments we need to make for things that happened over a period of time due to the accrual basis of accounting. And that we went over last week revenue and expense recognition, or on the first week, we went over revenue and expense recognition principles. So the business recognizes revenue when they earn it, not necessarily when they receive the cash. And so that more accurately represents the time when the business is actually performing the services or providing the goods to customers, and is a more accurate picture of like what the business is using. An accrual basis is required by GAAP. And contrast to accrual basis is cash basis. And under the cash basis of accounting, revenues and expenses are recorded when the cash is received or when the cash is paid. And so everything on the income statement is cash in and cash out for the business. And this is usually used by small businesses, because it keeps the accounting a lot simpler. We can just look at the bank statement or the credit card statement or the debit card statement of the company, and all of the cash transactions are either a revenue and expense or some sort of owner contribution or withdrawal. And it makes the accounting really simple. But with larger businesses, it's simpler to use accrual basis because of the amount of transactions, and usually the regular bookkeeping gets automated anyway. There's a lot more controls, internal controls in place, so business processes that get followed all the time for billing, for purchasing. And it's required for companies of a certain size by the IRS. They have to use accrual basis accounting for tax purposes. And the SEC requires that companies use GAAP as an accounting method. A lot of time banks will require an accrual basis of accounting, and banks and investors will look for accrual basis of accounting. Somewhere between accrual and cash is called modified cash basis. And that policy is specific to the company, really, and they take it account by account basis. And they specify in their financial in the notes to the note one or two to the financial statements is always summary of significant accounting policies, and they'll describe these accounting policies and also the more specific policies to each account. And if they're using a modified cash basis, they'll say, well, we're recognizing revenue on the accrual basis, but then all the other accounts we're recognizing on cash basis. And that can be sort of a company that's growing and they want to slowly implement accrual basis. And I've seen that just on a few clients, usually small to medium-sized nonprofits is the only place I've actually seen it done. But small businesses could also use that as well. But I've seen cash basis a lot more in small businesses. And the expense, so the revenue recognition principle is that companies recognize the revenue when they earn the revenue, when they actually provide the goods or services to the customer. And the expense recognition principle, also known as the matching principle, matches the expenses to the revenues that they were used to earn, or it matches the revenues to the expenses that were needed to provide that revenue to the business. And this allows managers and investors and other stakeholders to know how profitable was this revenue to generate, right? If profit margins were like 50%, that means that for every dollar in revenue, it cost $50 in expenses to create that revenue. And so then they got 50% profit, 50% expenses from that revenue, right, as a percentage of revenue, which is really different than a 10% profit margin, which would mean that there's 10 cents in expenses, 10 cents in profit, 90 cents in expenses. And that's why we really use the matching principle is we want to know how profitable was that revenue to generate. And that lets us extrapolate to the future, right? Where if this is the margins of the business, we can expect that to sort of continue in the future. And these revenue and expense recognition principles is what's going to drive every single one of our journal entries today for adjusting journal entries, because we have to make an adjustment to accrue revenue and accrue expenses that happened in the current period as of the end of the month. And for example, some expenses are not recorded daily. If we wanted to create a daily, right, supplies are used every day by the business in really small amounts. And if we needed to compute a daily income statement, we could. We could count up the amount of supplies every single day. We could record how much rent we paid for like our daily rent instead of a monthly rent. We could do a daily income statement if we wanted to, but that would be so much work, it would be costly and sort of irrelevant. The accounting is really supposed to support the transparency of the business and not really get in the way or be a cost, an unnecessary cost of the business. Most businesses prepare their books monthly for internal reporting and then report externally to investors and banks quarterly. And then there's a big annual report as well. So for example, with supplies, they would just count up the amount of supplies at the end of the month, make a journal entry for the amount of supplies that were used during the month. And that would be an adjusting entry because the entry wasn't recorded on the daily operations of the business. It was recorded at the end to adjust the supplies to the amount that it should be at. And some also some revenues and expenses are incurred as time passes rather than as separate transactions. For example, if rent is prepaid 3 months in advance, that rent revenue has to be recognized 3 months at a time. And the revenue isn't earned until the time passes. And also, some revenues and expenses might be unrecorded at the end of the accounting period because of general bookkeeping delays. For example, if a accounting firm or a consulting firm or a law firm has a contract with customers that they're allowed to bill a certain amount per hour for services, and then they provide a certain amount of services during the period, like 20 hours of services, but they haven't yet created that bill yet, there would be an adjusting entry to accrue that 20 hours of revenue for the firm, the client firm, they would record an adjusting entry to record the 20 hours of expense for those legal expenses that were incurred. The legal expenses were provided, or the accounting expenses, they were provided, but they haven't gotten the bill yet. Just because they haven't gotten the bill doesn't mean that the expense doesn't exist, right? And just because the firm hasn't billed its clients for that revenue that was earned, that doesn't mean they didn't earn the revenue. They did the service. We're matching the revenue to the period in which the service was actually provided. And this is all what's called the adjusting process, which is part of the month-end close process. And uh, all of the journal entries made as a part of the adjusting process are called adjusting entries. Each adjusting entry is going to impact at least one income statement account and an asset or a liability account on the balance sheet. And that's because we're accruing for revenues and expenses that happened during the period. And so each one is going to impact a revenue or an expense and an asset or a liability. And generally, these are also all going to be non-cash adjusting entries. Really the only point in which it would involve this process would involve cash would be when doing a bank reconciliation. And that will be in chapter 7. But with the difference between accrual basis and cash basis of accounting, we're accruing for these expenses. The only time it would be cash is if something appeared on the bank statement that the business wasn't aware of that happened during the period. For example, a returned check or a fee charged by the bank that the client, they weren't aware of it during the period, and now they have to adjust for that at the end. But this is all adjusting for stuff that was not recorded in the daily process of business and bookkeeping. And now it's the end of the month and we're just squaring everything away so the financial statements are correct for the period. And so there's types of accounts requiring adjustment. An accrual is when revenue has been earned or an expense has been incurred, but it hasn't yet been recorded. So if the accrual is for revenue, we're going to debit accounts receivable and credit revenue. And then if the accrual is for an expense, we're going to debit the expense account and then credit the associated liability account, such as accounts payable or wages payable. And they will be a payable because an accrual is when an expense or when a revenue or an expense has been earned but not yet paid. So if an expense has not yet been paid, that's a bill to someone else, that's a payable. If the revenue has not yet been collected, then that is an accounts receivable because it's a bill that's due to the business. And so this is what the journal entries will look like. For example, for accruing for revenue, debit accounts receivable and credit to revenue. For expenses, it's a debit to expenses and a credit to the relevant payable account. There's also what's called a deferral, and that's when cash related to a future revenue or expense has been initially recorded as a liability or as an asset. And over time, or as events happen, that asset or liability goes down and then the revenue or expenses go up. And so for example, if cash is received for future revenue, if customers prepay their revenue, that's called unearned revenue because the business didn't earn it yet. And then there's an adjusting entry to record when the revenue is earned. For example, if renters pay their rent a couple months in advance, then the rent would be unearned rent until it's earned, and then there would be an adjusting entry to record the rent revenue. There's also, if cash paid is for a future expense, it's initially recorded as an asset called prepaid expense. For example, prepaying for a year of software. That's a really common one that businesses do. For example, Anoka Ramsey prepaying for a year of Microsoft 365 and paying Microsoft to host, email accounts for 20,000 different students, right? That's a big expense for Minnesota State. And then there is an adjusting entry required as the prepaid expense is used up over time. So prepaid insurance, prepaid software expense, that slowly gets used up month by month, and then every month there's a journal entry to slowly reduce that asset as the expense is incurred. And so the journal entries would be for the unearned revenue. The initial journal entry to create the unearned revenue is a debit to cash, credit to unearned revenue. And then to adjust at the end of the period, it's a debit to unearned revenue and a credit to revenue. And then for expenses, it's initially created as a prepaid debit to prepaid expense and a credit to cash, and then adjusted as a um, as a debit to the expense and then a credit to the prepaid expense. And so here's the unadjusted trial balance for net solutions that we were going over last week. And uh, we had all of our cash, accounts receivable, supplies, all of our accounts. We're going to be doing the journal entries, the adjusting journal entries for this example, and then also creating an adjusted trial balance. And there's a few updates to our chart of accounts, the few additional accounts that we are going to be using as a part of these new journal entries. One of which, so we have depreciation expense and accumulated depreciation. That's to account for the cost of fixed assets over time. Uh, Insurance expense comes from our prepaid insurance adjusting entry, rent revenue from the unearned rent, wages payable uh, from accruing for wages that happened between if between the end of the financial statement reporting period and payday at a later date. So there's also um, can be accrued revenues. This is the example where at the end of the accounting period, there's revenue that's earned, but it has not yet been recorded. And in such cases, the revenue is recorded by debiting an asset and crediting a revenue account. For example, Net Solutions has an agreement with another company to provide services at a rate of $20 an hour. And they provided 25 hours of services, but they didn't send the bill yet. And right, usually the billing team is what would record this revenue as a journal entry, but they haven't sent the bill yet. So the billing team hasn't posted a journal entry, but we need to make sure this revenue is reflected on the income statement. So we make a journal entry, debit accounts receivable, credit fees earned. And so that increases our revenue for the period. And notice how like there's no cash involved in this transaction because we're just accruing the revenue at the end of the month to record the services we provided. And if we did not do this journal entry, our revenues would be understated, our net income would be understated, our balance sheet would be overstated, or our balance sheet assets would be understated, and equity would be understated if we did not make this journal entry. So it's required for the books to be accurate under the accrual basis of accounting for these journal entries to be done correctly. And accruing revenue or the accrued revenue journal entry is probably one of the most looked at journal entries by auditors. And that's because this is a non-cash journal entry done at the end of the month by the finance and accounting team, and it directly increases revenue and net income. So if there is cooking of the books to be done, the adjusting journal entry process is the primary and easiest way that it would be to do it because we could just say that there were 60 hours of services provided instead of 25 hours of services, and then reduce that in the next month. And Dank Dankner Co. is never going to know the difference because they're going to get the correct bill 3 months from now when they pay for all of it, right? So if the CEO comes in and takes a look at the preliminary books and is like, yeah, I saw our numbers for this quarter and they're just not right. Like I just know that we made more money than that. How is that possible? How did we make more money than this? And with the implication, like find something like this to do, right? And so that's why it's so important to be ethical in accounting. If that ever happens to you, uh, start looking for a new job. That's not a sustainable work environment to be in, right? But like this happens in the real world. I don't. Under Armour had a fraud a couple of years ago where they were accruing revenue in advance of when it had been earned, basically. They had contracts with customers to provide services, and they were accelerating the revenue from future quarters to the current quarter. And that's all done as a part of this adjusting journal entry process. And and eventually it caught up with them, right? So they were doing it because they were under these constant pressures to make revenue goals because they were trying to grow revenue every single quarter. Well, they ran into a bad quarter, but they said, oh, it's fine. We're growing so fast. We'll just pull some Q2 revenue to Q1 and revenues will continue to grow. And then eventually when Q2, when we grow even more, then we'll balance it back out and and it'll all be good. Well, it wasn't all good because then Q2, right, their revenues were even worse and they either have to commit additional fraud to cover it up, or revenue drops substantially in the following quarters because it's all just a shifting of the revenues and expenses from period to period. So that's why this is all so important. One, it's important to do this so that the books are accurate, but it's also important to do this accurately so that because eventually their revenue went down because they couldn't keep doing this anymore. Like it gets to continue to show more growth and more growth and more growth, right? Because if we shift $500 from Q2 to Q1, well then in Q2, if we didn't make like $500 more in revenue, then revenue is gonna, even if revenue is flat, like real revenue is flat between the quarter, then Q2 is gonna have 500 less in revenue because it was shifted.
So people just kind of noticed over time.
People noticed it only took a few quarters and the business did not improve like they were expecting it to. And so their revenue decreased, and people noticed that it was decreasing sort of excessively. And then people started asking questions, particularly the auditor, and they did get fined. And yeah, like a lot, like there are consequences for this kind of thing. So yeah. So eventually, uh, people started asking questions because revenue started dropping. Eventually, it does have to catch up with the real revenue of this situation. Um, so yeah, yeah. So I think they were fine. Like it was in the tens of millions of dollars for this. And then it's also like investors hate that kind of thing too, because then they can't trust the accounting team. Um, so we're going to go over the amount of misstatement that would occur by omitting these journal entries as we go here. There's also accrued expenses, which are um, services used in earning revenues um, that are paid for after the service has been performed. And then we have an adjusting journal entry. We're going to go over wages, uh, adjusting entry for wages paid. And so in this example, it's easier to look at this with the calendar. So they paid wages expense of $950 they get paid every 2 weeks on Friday. So they payday in this example here is the 13th, the 27th, and the 10th of January. And so they get paid $950 in the first 2 weeks, 1,200 in the next 2 weeks. And then they determined that for the 30th and the 31st, the amount of wages that the employees earned was $250. And then um, the amount of wages incurred then in the first 10 days of January was $1,025. And so what we have to do is debit to wages expense and credit to wages payable for the amount that we owe to our employees for the last 2 days in December. Then there hasn't been a payday yet, so they haven't gotten that cash yet. Um, And then when the wages are actually paid out in January, then we debit wages expense, debit wages payable, and then credit cash for the full amount of the payday on January 10th. And no, only 1,025 of the $1,275 in like cash paid on the 10th is allocated to January because this $250 was already allocated to December in the adjusting journal entry at the end of the month. And if we forgot to make this journal entry, our net income would be overstated and our expenses would be understated and our liabilities would be understated because, right, we owe that cash to the employees. They've earned those wages, so that's a liability of the business. And so at the end of the accounting period, an adjusting entry to record revenue that has been earned but not yet recorded would include which of the following? Anybody have any ideas? I know someone's got to have an idea.
B, debit an asset and credit the revenue.
Yep, perfect. So yeah, exactly. It'd be generally debit accounts receivable and credit to revenue. And for example, this journal entry here of with at the end of the current year, $17,950 in fees have been earned but not yet billed. So if we have a journal entry to record these fees, it'd be debit to accounts receivable, 17,950, and then a credit to revenue for the same amount. And if cash basis rather than accrual basis was used, there would be no entry required because under cash basis, we're only recording things on the income statement if there's cash paid or cash received. It's only money in it. It's only cash in and cash out. And so Stenberg Realty pays weekly salaries of $18,500 for a 5-day work week ending on Friday. Journalize the necessary entry at the end of the accounting period, assuming the period ends on a Monday or on a Thursday. So what we're going to have to do here is we know that they make $18,500 a week. We know there's 5 days in a week. So we have to compute the daily wages that these employees are earning. And then that's going to be 18,500 divided by 5 is 3,700. And so if the accounting period ends on a Monday, but payday's on a Friday, then this will be our journal entry. We debit supplies expense for 3,700, credit salaries payable. But if the end of the accounting period is on a Thursday, then there's 4 days of payroll that have been earned by the employees but haven't yet been paid. And so the salaries expense accrual will be 3,700 times 4 is 14,800 debit to salaries expense and then a credit to salaries payable. And then on Friday, they would get paid, and that would be in the following month. And the journal entry for that would be um, salaries expense for the single day would be a debit salaries expense 3,700, a debit to the salaries payable of 14,800 because they're paying back that liability, and then the credit to cash for the total weekly pay of 18,500. And we can determine the wages paid based on the T account, and it does really help to write this out. So if we have wages payable of 3,700, we know the ending balance is 3,700, and it says this is the first month of operations. So wages payable and is a credit of 37,300 at the end of the month, and the wages expense balance is 54,750, which increases wages payable over time. But it says, what's the actual cash paid for wages during the month? It's the first month of operations, so we can assume the beginning balance was 0. And so The debit needed, which went debits to a payable account, are generally the payable being paid back. And so if we take 54,750 minus 7,300, then 47,450 would be the amount of cash paid for wages during the year because that's what balances out our journal entry there. Or that's what that's what plug that's our plug to the T account. So we had a beginning balance of zero, credits of 54,750, and then an ending balance of 7,300. If if the beginning balance was 1,000, then our cash paid would actually be more because we have 1,000 more in debits, but our ending balance is the same. So if our beginning balance was 1,000, then our cash paid would be 48,000 instead of 47,000 because you can think of it as they had to pay back last month's wages. Then we had the wages expense for this month, and then the payments that were made, and then the ending balance at the end of the month. And so, we can play whatever algebra games that we want with this with the T account this way, but writing it out, which is what I do when I'm working through these problems on my own, writing it out makes it so much less likely for mistakes to happen and so much easier to understand uh, what amounts need to go where. And so another example here, we have unearned revenue. If we remember, this was a neighboring business was renting a parking spot for $360 for 3 months. So that's $120 a month in revenue. And so at the end of the month, we need to create a journal entry that debits unearned rent and credits rent revenue. And you can see our T account here was initial balance of 360, a debit of 120, and then we have our ending balance or the adjusted balance of 240. And those new adjusted balances are what's going to go onto our adjusted trial balance and then the financial statements. So then once we have our adjusted trial balance, we'll create the financial statements. And so that'll be chapter 4 will be using the adjusted trial balance to create the financial statements and then prepare closing entries to close out the books and get ready for next month. If we omitted this journal entry, we would have understated our revenues, understated net income, overstated the liabilities, and understated equity because of that. There's also prepaid expenses, which is when we had two prepaid expenses that occurred during the period. One was a supplies expense and another supplies and supplies expense, and the other was prepaid insurance and insurance expense. For supplies, we know we have an ending balance of 760, and so the supplies used up during the period was 1,240. And so we debit supplies expense and we credit supplies to reduce our supplies. And for prepaid insurance, they prepaid starting December 1st for 12-month insurance policy. And so the prepaid insurance, the initial was paid was $2,400, which is $200 a month. So every month we need to record a $200 expense and reduce our prepaid insurance asset by the same amount every month. And so we debit insurance expense and credit prepaid insurance. And our beginning prepaid insurance balance was 2,400, and then we have our credit of 200 and then ending balance of 2,200. And if we omitted these two journal entries together, that's 1,440. Then that would understate our expenses, overstate net income, uh, overstate assets, and also overstate our owner's equity. And That's why it's really important to like most of the mistakes found in an audit are not intentional frauds. A lot of times they're actual mistakes. And I actually came across this once um, as an intern. I was in doing some nonprofit audit items for really small businesses, but sometimes they were larger nonprofits. And basically, they had prepaid like $80,000 for a software expense contract for the year as of in like October 1st. So then now it's the end, it's 12/31. 3 months of that has passed. And I didn't even think anything of it because I'm an intern. Like I don't know anything. But I just asked the client on a call and I was like, oh, so why wasn't that recorded as prepaid? And they said, oh, we don't do that. And it's like they weren't trying to pull one over on anybody. Like they weren't trying to commit a fraud, but or they weren't trying to like commit an error or something like that. They just hadn't done it in the past. In the previous year, they had a prepaid contract as well, and they just sort of were rolling it through, and they were recognizing the revenue as they went or the expenses as they went. They recorded it as a prepaid, but then they just were not recording the adjusting entry at the end of the month. Well, that ends up being a $20,000 mistake on the income statement, right? So then um, the expenses should have been $20,000 more at the end of the period. And so then that was just a conversation between the partner and their accounting team about, hey, you should really do prepaids. You should really accrue properly record your adjusting journal entries for prepaids. And right, they corrected it. Um, but yeah, that was fun. I mean, like this is stuff, this real stuff that happens and comes up. And sometimes uh the errors can be in the amount, and sometimes the error can be just forgetting about it. I mean, if generally if we've never done, if the business has never accrued for prepaids before, they might not think that that's even something that should be done in the future, right? So it's really important um, accounting info. And sometimes prepaid expenses are made at the beginning of the period in which they will be used or consumed. For example, paying rent for December on the 1st of December. We would not need to record a prepaid for that because we're doing our reporting on a monthly basis. So if they paid rent of $800 for December on the 1st of December, then they could just record it as debit rent expense, credit cash, um, because that prepaid is going to be used up in its entirety in the accounting period. If they were prepaying for 2 months of rent, then it would be different because it spans two accounting periods. We could make a day, again, like we could make a daily income statement and then accrue the rent daily, but there's no real purpose to that because we're only reporting on a monthly basis. That's what's relevant to our internal stakeholders. And then externally, we're reporting on a quarterly basis. So it really doesn't matter if we're accruing this every day. And so we shouldn't because we're meant to be as efficient as possible in doing the accounting. So on November 20th, Cassie purchases a $200 tickets on Delta Airlines to fly to Orlando for January 28th next year, assuming Delta has a December 31st year end, which is the credit to record the initial sale on November 20th. Yep, exactly. And airlines generally have a lot of unearned revenue because people purchase their airline tickets in advance and they're almost always paying cash in advance for the airline tickets. And so between uh, the air traffic liability or that unearned revenue for plane tickets and the unearned revenue that they have for their airline miles program, there's generally a large amount of unearned revenue in airline balance sheets. And so there's a number of different types of adjustments. For example, a 2-year premium is paid on an insurance policy is a prepaid expense. Fees earned but not yet received is accrued revenue. Fees received but not yet earned is unearned revenue. A salary owed but not yet paid is an accrued expense. A subscription received in advance is an unearned revenue. Supplies on hand is a prepaid expense. Taxes owed but payable in the following period are accrued expense, and utilities owed but not yet paid are also an accrued expense. And so these are just the types of journal entries that occur, but every single one of them affects either a revenue or an expense and an asset or a liability. They're all adjusting our revenues and expenses to make sure that we are in line with the accrual basis of accounting. And there's a number of accounts that generally do or don't require an adjusting entry. Accounts receivable generally does require an adjustment of some kind for fees that haven't yet been billed. Uh, Buildings generally no, but accumulated depreciation for buildings, yes. And so we'll get into the depreciation entries in just a moment. Oops. Um, and capital accounts generally do not require an adjustment. Interest receivable does normally require an adjustment, and that's an accrued revenue. If it was interest payable, that would be an accrued expense journal entry. But an interest receivable is interest that is going to be collected by the business, so that's going to be revenue because they're receiving it. If it was payable, it would be an expense because they're paying out the interest. Land does not require adjustment. Land also is never depreciated because there's a set amount of land that doesn't decrease over time, right? We prepaid rent does normally require an adjustment. Salaries salaries payable, supplies, unearned fees, and wages expense all are accounts that generally require an adjustment. And so if we're creating the adjusting entry for unearned fees, then the balance in the unearned fees account is, so if it's 18,000 before, and then if we know the unearned fees amount needs to be 3,600 at the end of the year, we have our T account, our balance before the adjustment of $18,000, the adjusting entry of 14,400, and then the balance after adjustment of 3,600. Could think of this as um, a law firm that's received a retainer to complete services. Uh, a lot of times, lawyers, they'll accept a retainer, right? And then in that retainer contract is, okay, now you have me, you have my attention, I'll do whatever is needed for your case. And then my billing rate is $100 an hour or something. And so um, the the retainer would then get reduced at the end of the month for $100 for every hour of services that was performed. So in this case, if 144 hours were worked on for this client, then they would accrue 144 hours worth of revenue, 14,400, and then the balance after adjustment is 3,600. And then they'd send the client a statement or something later. The balance in the supplies account before adjustment is 5,175, and then the amount of supplies on hand at the end of the year is $615. And so we have a debit of supplies account balance before adjustment of 5,175. We know it needs to be 615, and so we take 5,175 minus 615. We know the credit that we need, and then our supplies expense is 4,560 as a debit, and then credit to supplies to reduce it. We also have the supplies expense accounts throughout the period here. And, we have amounts that have been posted to each of these accounts. And so we have a beginning balance of zero is implied here. and it's an asset account, so that's a debit. And then an ending balance of 2,550. And then we had a supplies expense balance of 7,120. And it's right when we do our journal entry to accrue for the supplies expense, that's a debit supplies expense, credit supplies. So we know we had 7,120 in credits to supplies account. And so the amount of supplies purchased is the 7,120 plus the ending balance, subtract any beginning balance, which in this case was zero, and we get 9,670 in supplies purchased throughout the period. But let's say that we had $2,000 in supplies on hand at the beginning of the period, then our our supplies purchased throughout the period would go down because the supplies that got used up, this 7,120, that's the supplies that got used up during the period. And so, um, right, if we had a higher beginning balance, that means that less supplies were purchased. So there's a direct relationship there in the algebra of these accounts, right? If one of these numbers changes, something else has to change because um, right? It's an algebraic formula to get to the end beginning plus purchases minus expense our ending balance. And so there will be a number of problems on I would say this is a prime quiz question right here, where you're given a beginning balance, an ending balance, an expense, compute supplies purchased, or you're given beginning balance, purchases, ending balance, what's the expense? Prime example of a possible quiz question. And so if we're doing an adjusting entry for prepaid insurance, the balance before adjustment is 22,500. And then the amount of insurance there's two ways that they can give us this problem. A, the amount of insurance expired in the year is $18,000. And so the journal entry then is pretty straightforward. Debit insurance expense $18,000 and a credit of prepaid insurance $18,000. But if they say the balance at the end of the year has to be 4,500, we have to take 22,500 minus 4,500. Well, it still happens to be $18,000, but they're both valid ways that they can give us the problem in that way. So, um, another example here is the had a the prepaid insurance account had a beginning balance of $3,000 at the beginning of the year. The account was debited for 32,500, and then we have two possible examples here where they give us the unexpired insurance value or the amount of insurance that expired during the year. So for B, the amount of insurance that expired during the year, that's the expense, right? That's the amount of insurance that was used up during the period. And so that would be insurance expense 3,700. If we know the ending balance, that's another algebra problem for us here. And so we have prepaid insurance. Then we have a beginning balance of $3,000. And we know it's an asset account, so it's going to be a debit balance. Account was debited for 3,200 or 32,500. And we can assume that that's insurance premiums that the business has paid throughout the period. And then the unexpired insurance left, that's what's going to remain as a prepaid on our balance sheet. That's 4,800. And so what we need to figure out here, because this is an asset account, we need to figure out what the expense was, which will be our credit. And so what we'll do is we will take the beginning balance plus the additions minus the ending balance. That's going to arrive at what our credit needs to be. And so the credit is 30,700. Does anybody have any questions about that? Cool. Yeah, T accounts are fun. It's really, I think it just makes a lot more sense when done this way. It's a lot like those problems in week one with the statement of owner's equity, where we had beginning owner's equity, new investment, net income, withdrawals, ending balance. There's a formula there, and if we're missing any one of those items, then we know that we can plug it algebraically to figure out what does it need to be. So for adjusting entries for the unearned fees and accrued fees, there's two adjusting entries in this problem here. So we have the unearned fees account before adjustment is 97,770. Of these fees, 39,750 have been earned. In addition, $24,600 of fees have been earned but not yet been billed. And so of the unearned, we're going to have an unearned fees revenue accrual, and we're also going to have a unbilled revenue entry. And so it's going to impact both. Uh, the first one is going to be a debit to unearned fees. So we're reducing our deferred revenue liability and then accruing the revenue for it. And then in the second example, for fees that haven't been billed yet, they're going to be paid later. So that's an accounts receivable. So we're going to debit accounts receivable and credit fees earned. And once again, in an audit, revenue recognition is always presumed as a risk. There's always sort of a risk in revenue recognition that's presumed. And so this kind of journal entries would be heavily scrutinized by the auditors because they're so easy to um, manipulate if there's no scrutiny over them, right? Because um, it can be subjective, right? There's no cash that's being transferred. Not a lot of evidence of what has been accrued. And other than, right, a lot of times what the auditors will look at is the contracts and the billing records to figure out what has been accrued. Or, for example, if this unearned fees thing is big example is a manufacturing or a wholesale company, and they have uh, let's say that they agree they're going to sell $10 a unit. They're going to sell 97,000 they're going to sell 9,770 units for $10 a unit. If they ship 3,000, let's just do $1 a unit. If they are going to charge $1 a unit and they have 97,770 units on the contract and they ship 39,750, that's how much revenue they get to recognize. Assuming that that's how the contract is written out, they could accrue that amount of revenue. And so, what an auditor would look at in that case is shipping records. How much did they actually ship to the customer? Because, um, otherwise the accounting team could just say, oh, we shipped 50,000 units or we shipped 60,000 units, right? So that's where the risk is here. But that's also why it's so important, why these entries are so important is because they directly affect the net income and the earnings per share for the quarter so significantly. But it's also why, like, this is why it's not also this would be the easiest and highest risk way to do it, but also this is where the auditors are looking for it as well. And a lot of times it's fairly easy to prove and catch with billing records, shipping records, whatever, what revenue has actually been earned and should have been earned. And if you go working as an auditor in public accounting, you will spend a lot of time essentially comparing and matching documents, sales order, shipping order, payment receipt, um, to verify uh, revenue testing it basically to verify that the revenue that has actually been earned or not earned, it's done as a sample so that the whole selection isn't tested, right? But we're just testing a portion. And we also have adjusting entries for depreciation expense. So depreciation is uh, how we allocate the cost of fixed assets over time. And fixed assets include land, buildings, equipment, cars, any sort of long-term asset could be called a fixed asset. And fixed assets such as office equipment are used to generate revenue, much like supplies are used to generate revenue. And unlike supplies, there's no visible reduction in the quantity of equipment. But as time passes, the equipment loses its ability to provide useful service. This decrease in usefulness is called depreciation. Um, and all fixed assets except for land lose their usefulness. So land is never depreciated. And that's really important. And it's because land doesn't lose its value over time. If there was if we think like really the only way that land could lose its value or its usefulness is if there was some sort of major earthquake or chemical flood or something like some very big point in time disaster. Depreciation is an adjusting entry for the amount of stuff that just happens naturally over time. That's an earthquake destroying the land or like the land being taken away by the sea as part of a hurricane or something, that would be a point in time, like sort of disaster expense. That is not depreciation because depreciation happens naturally over time, essentially. So, long story short, don't depreciate land. And that is the source of a lot of accounting jokes about depreciating land. Uh, and so we record an adjusting entry to record depreciation expense to an accumulated depreciation account. We do not, so an accumulated depreciation is what's called a contra account. So it is accumulated depreciation is an asset account, but it has a natural credit balance. And generally, unless the fixed asset is being sold or disposed of, accumulated depreciation will always have credits that happen to it. And so our entry to record depreciation is debit depreciation expense, credit accumulated depreciation. And the right when we have our building, for example, if we're depreciating a building, we have our buildings asset as an asset. It's a debit account. We do not a common what we do not do is debit depreciation expense and credit buildings. That would be incorrect because we want to right. We debit depreciation expense, credit accumulated depreciation. But for example, for this example is office equipment. The office equipment balance is 1,800, and then the accumulated depreciation office equipment is 50. And so then we know and we keep track of what was the original historical cost of the office equipment. And then we have the accumulated depreciation of the office equipment. And then that's shown on the balance sheet right underneath it as a contra account. And then we take office equipment, subtract the accumulated depreciation, and we get what's called a net book value of the asset. And the book value, so the book value of the asset is calculated as the cost of equipment minus the accumulated depreciation. And this is different than the fair value of the asset. So the fair value is like, what is the asset actually worth today? For a car, you could think of it as the Kelley Blue Book value, or like what's the trade-in value of the car, right? That would be the fair value. But the book value of the asset is the initial historical cost minus the accumulated depreciation is the book value. And generally, they do track each other, right? Because the accumulated depreciation builds up over time as the asset has been used. If we're going to use a car over 5 years, we would take the value of the car, divide it by 5 years, and then depreciate it over 5 years. We divide out the expense over time. But that's not generally how depreciation works, right? It's like the car fair value drops significantly right after it's purchased. And then maybe at the end, when the car is fully depreciated, the car might be worth more than its book value at the end of the 5 years because it retains its value or something, right? If we think about if we're depreciate, and this is just a straight line depreciation example. If we have the initial beginning value of the car, the historical cost is here. That's the same as its fair value, right? Because we're purchasing it at a fair value. Then we're depreciating the car over time, right? It's the book value slowly going down, and we're we're using up the book value of the car. We're having depreciation expense. Meanwhile, the actual graph of like the fair market value of the car might be something like this, right? So, and then maybe if we'll get into more specifics of depreciation in the fixed assets chapter, but book value and fair value generally track each other, right? Because the value of the asset is related to how much it's been used. But they're not the same, and we're tracking depreciation. The purpose of it is to match the expense of the car or of the fixed asset to the revenues that it helped to generate. And so if we're going to use this car to generate revenues over 5 years, we are going to allocate the expense over 5 years. And we're not trying to track the fair market value movements of the car throughout the period. We're trying to account for the expense for the revenues. Um, and then, the net book value of an asset can be zero. Sometimes they have a salvage value, which would mean there's like a minimum value. And so then it would depreciate down like this, and then there's like a floor, and they wouldn't depreciate it below that. But just because the asset is fully depreciated doesn't mean it still can't be used, right? This projector here was probably depreciated over 7 years, and it's clearly more than 7 years old, right? So, and that's what's called fully depreciated, still in use. So that would mean the book value is at like zero or something, or the salvage value is like the ending value, but it's still in use. Like my car took two tries to start it this morning. Just takes a little bit of finesse, right? But that would be fully depreciated, still in use, right? It's got over 250,000 miles, but it's got me here. So thankful for that. And so this would be how it appears on the balance sheet. So if we think about, well, there's on the balance sheet when you're filling it out, there'll be these like sort of subtotal columns. And so if we have all of our assets like cash, the balance, supplies, the balance, accounts receivable, the balance, and then office equipment, we have it indented a little bit. We have our historical cost, office equipment 1800, accumulated depreciation of 50, and then in this column here is the total of those. That's a net book value of 1750. And there will also be different accounts for each of the asset classes for depreciation. And so you'll find this on the chart of accounts when you're doing the when you're doing the chapter homework. There'll be accumulated depreciation, buildings, store equipment, office equipment. And that's so that when we're doing the reporting, there's usually a footnote to the financial statements that details all the different types of fixed assets a company has, and they break it out by the classes of items because investors are interested in how quickly are the assets going to depreciate, right? So if they just have this huge balance of um, fixed assets that are going to get depreciated, store equipment and office equipment is going to depreciate a lot faster than buildings. And so it's important to break them up. And so in the chart of accounts, you can look for if you're depreciating office equipment, accumulated depreciation, office equipment, and you can just copy that right into the journal entry line item. Otherwise, you'll have to type all that out. But you can't just put accumulated depreciation or it'll show up in red because it's not what Cengage is looking for, right? It's looking for the accounts that are in the chart of accounts. And if we did not depreciate our assets, We would understate expenses, overstate net income, overstate the net book value of our assets, and then overstate our owner's equity. So let's just assume that Walsh Construction Company paid $120,000 for a used cement truck. It has an estimated life of 10 years and is depreciated straight line, which is, and then so after 6 years, the truck has accumulated depreciation of $72,000. So what is the net book value of this cement truck? Yep, exactly. So what they did here is they depreciated it straight line uh, and at $12,000 a year. And then um, at the end of 6 years, 72,000 in depreciation, and then they've got 4 years left. So that's $48,000 of net book value left of the asset. And the estimated amount of depreciation. So in this chapter, you're not going to be expected to calculate the depreciation amounts. It'll tell you, much like this, the depreciation was $66,290. Do the journal entry. And so the journal entry here is debit depreciation expense, credit accumulated depreciation for that amount. And in the fixed assets chapter, we will go through a number of methods on how to do the math to calculate uh, each of the methods of calculating depreciation, whether it's accelerated depreciation, whether it's based on units of use, such as miles driven on the car, uh, and and also doing like mid-year depreciation as well. And so in this example, they have equipment balance of 3,150,000 and a balance of accumulated depreciation 2,075,000. The book value of the equipment is then 1,075,000 because that's the balance minus the accumulated depreciation. And that doesn't necessarily mean that the equipment has decreased in value by 2,075,000. That doesn't actually mean that if they sold the equipment today, they would get $1,075,000 for it. That just means that isn't that the accumulated depreciation is an allocation of the expense of purchasing the equipment over the period of time in which it's expected to be used. And it generally does track the value of the asset. It's correlated, right? It's correlated to the value of the asset and the fact that it goes down over time. And generally, the useful life of the asset is the amount of time in which you could sell it for something, but it's not exactly what the fair value of the asset is. And the depreciation doesn't exactly track the loss of the value of the asset. And so we'll just do a summary of the adjusting process here. Adjusting journal entries are always dated as of the last day of the month. And because collecting the adjustment data requires time, the journal entries are usually recorded at a later date, and there's usually an explanation with each adjusting journal entry. So what this means is that there's a month-end close process, and it takes a lot of time to collect all the data for a month-end close, to collect all the unbilled billing data, to track down all the prepaid insurance contracts and the prepaid rent contracts. There's all these things to be done, right? And so usually what happens as part of the month-end close is and I'll go over this for like a large company, but it would be applicable to a small company as well. So I worked on a client that had over 20 different countries in which they operated in. And the countries each had their own business unit and their own profit and loss statement, their own books. And so they have a schedule for each workday after month end ends. And so they have like, let's say that their month end close process takes 12 business days. Business day one, all of the individual subsidiaries are going to create an unadjusted trial balance. Then on day 2 and day 3, they're going to do all the adjusting journal entries. On day 4, they're going to prepare the adjusted trial balance. And then day 5, they're going to get that all sent up to the corporate consolidation level. And then on day 6, corporate is going to do all of their adjusting journal entries. And then on day 7 and 8, corporate is going to start preparing the financial statements for the month. And so there's a whole process and there's things to be done every single day. But even though there's adjusting journal entries, in this example being made on business day 2, 3, and 6 of the month, all the journal entries are going to be recorded with the date as of December 31st for the December 31st month end, even if the journal entries are being made at some point in mid-January. They're going to be backdated to December 31st because they need to write our financial statements. We have our balance sheet is as of December 31st, 2025. Income statement is for the year ended December 31st, 2025. So we backdate it so that in the accounting system, as of December 31st, everything is accurate. Everything has been adjusted and properly accounted for. And so there's a number of, does anyone have any questions about the month-end close? So that process is going to be overseen by the controller of the business, who the controller is sort of the head of accounting for a business. And then the adjusting entries as a whole are usually done by the responsible parties. For example, there's going to be, if it's a large company, there's an accounts receivable team that would, or a sales billing manager team that would handle the accounts receivable adjusting entry for fees earned but not yet billed. And then the payroll team would handle the adjusting entry for wages expense that haven't yet been paid. And unearned rent would maybe be done by like sort of the corporate accounting team or maybe the team for which this whoever was responsible for accounting for this in the first place would have to submit that adjusting journal entry. And it would all be tracked on either some big sort of accounting software that says that's basically just a big checklist. All these different entries need to be done, make sure nothing's been missed. Sometimes it's organized in a big spreadsheet. And so all of the individual, right, and then supplies expense and insurance expense would be sort of the office accountant would have to record that, or maybe corporate accounting would handle it. Depreciation expense and office equipment depreciation would be either corporate accounting would handle it, or if it's a huge company with a lot of fixed assets, there's usually a fixed assets accounting team or somebody's responsible for all these items. And then the controller makes sure that every single one of these items have been done and they collect all that information. They collect the journal entries and make sure that all the entries get posted to the ledger, and then which impacts the balance of each of our accounts. And then there's usually a memo for each one too, uh, that shows why was this entry made. For example, the accounts receivable revenue entry says accrued fees 25 hours at $20 an hour. And then if it's a particularly important journal entry, there usually will be like some documentation attached to it too in the accounting system. Like there'll be, right, if you're like filling out something in QuickBooks or SAP, there'll be an option to like upload the receipts or upload the contract or upload some sort of billing statement to accrue for this. And then we post each of the adjusting entries to the T accounts and to the ledger accounts. And then once we have adjusted each of the balances in our accounts, we create the adjusted trial balance. And these are, we'll skip over these because I think we went over a lot of, the impact of omitting these journal entries. But it's really important to record these on time and accurately so that the amounts are recorded in the correct period and for the correct amount, because it directly impacts the income statement, and the balance sheet, and the amount of net income for the year. And a lot of these adjusting entries, um, they're shifting revenues and expenses from one period to another. So, right, prepaid expenses were paid for in a prior period and are now being accrued for now. They're being recognized now. And then, accrued expenses, accrued revenues, the cash is going to be collected or paid later, and we're pulling that into the present because it's when it's been earned. And then so we have some prepaid tax and accrued tax journal entries here. So in this example, this is a real estate developer, a construction company paying, they've got this property that they're developing. And so they have 18,000, they prepaid for 12 months, $18,480 for taxes to the city for license fees. And then they know that they're going to owe property taxes for the current year in January of next year, and they know that that property tax amount is going to be $45,000. And so we need to accrue both of these tax expenses for the current year. So for the 18,480, this they paid in May, on May 2nd, really May 1st, they paid $18,480 in taxes for 12 months. But May, between May and December 31st is 8 months. So we have to find the monthly rate for these, like how much monthly is the tax, and then divide it out over 12 months, and then multiply by 8 months because that's the amount that was used up of this prepaid taxes. And so we take 18,480 divided by 12 times 8, and we get $12,320 in taxes. And then the next 4 months will be recognized in the following year. And then we also have to accrue for the property tax expense because the property tax is for the current year, but it's going to be paid in January. And so we record tax expense and tax payable of $45,000. And this is also done with um, estimating income taxes too. So if a business knows that they're going to owe taxes April 15th, or the corporate tax deadline is March 15th. If they know they're going to have to pay taxes on March 15th, they have to accrue for that in the year in which the taxes were actually sort of earned, when the profit was generated that's going to be taxed. So for a recent, and these accrued expenses and accrued revenues are huge aspects of the income statement and the balance sheet. So for example, Costco had accrued salaries and benefits on its balance sheet about $4 billion, and they had 6.7 billion in operating income. So if we assume that $4 billion of accrued expense entry, if we assume that journal entry wasn't included in the like if it was just omitted, their operating income would have almost doubled to $10.7 billion. So the numbers can get quite huge very quickly in these adjusting entries, and they can be incredibly material to the business. And so materiality is sort of an importance factor, right? We're at a financial statement auditor is not trying to catch somebody stealing a 20 every day from the cash register at Costco. Investors don't care. The company has $6.7 billion in revenue. Do you think that an investor really cares if they're stealing $20 from the cash register? Not really. Is that a controls issue? Is that a fraud risk issue? Absolutely. Indicates a lot of like sort of bad management going on if employees are stealing from the company. But that's not, and if an auditor finds something like if an auditor found out like that was happening, they would just tell the manager, and that would be the end of it, right? They would just tell that employee's manager. They might report that to be like to higher levels of management saying, hey, you have a problem. There's some minor level theft going on at the company. But is the auditor going to report that to investors? No. because the investors don't care. But investors do really care about these giant adjusting entries that are done. Like the accuracy and inclusion of these journal entries is so important because, right, the revenue could have increased, or not the revenue, the operating income would have been 60% higher if they just forgot about this journal entry. And then, another example is for Kroger. They had operating income of 2.8 billion, and there's an adjusting entry of 1.4 billion of accrued salaries and wages at the end of the year. And so if they didn't, the amount of misstatement if they didn't record that would be 1.4 billion, but that's 50%. That'd be a 50% impact to operating income. And so audits, they have what's called there's a materiality threshold, like it's quantified. And generally there's overall materiality, which is the auditor is basically looking at the financial statements and saying these financial statements are materially correct, which is correct within some materiality threshold. And generally the threshold is 5% of pre-tax income, which in this case, this was operating income, which is not the same as pre-tax income, but it's similar. So let's say that their threshold is, oh, and so then that materiality can be quite high. But if they're verifying that everything on the financial statements individually or as a whole is with under this certain threshold, and that threshold isn't public, like they don't just go out and say if operating income here is 2.7, 2.8 billion, they don't just go out and say that the threshold is $150 million. They don't just go out because that's 5% of 3 billion is 150 million, right? That's likely what this I've never worked on Kroger. I don't even know who their auditor is, but that's likely what their materiality level is. So the auditor is just saying, they're just looking at the books and they're saying, are the mistakes in aggregate less than $150 million? Great. And then they're done. Because when looking at the total amounts for these businesses, investors don't sweat the small stuff. It's got to be something that would materially impact an investor's decision for it really to matter here. So, and then right so even if their total materiality though is $150 million, they would have smaller thresholds for individual mistakes, right? So if and then generally like if their overall materiality is 150,000, individual mistakes over 15,000 are going to require some major internal memo to justify, right? And then they'll take all of those tiny mistakes, they'll add them all up, they'll take a look at their memos, they'll verify that everything is under that total mistake amount, and then they'll say, okay, we're good. But even those small mistakes, those will be there will be discussions between the audit team and the accounting team and the board and whatever about those mistakes if they're happening. Like a $15 million mistake, still not acceptable, right? That's still not like an acceptable mistake by a business. But that's not something the auditors are going to bring up to investors. That's something that the auditors are going to bring up to the CFO and the accounting team. Be like, hey, get your stuff in order. Like you need to fix this, but also it's small enough that we're not like reporting you to investors for major mismanagement or something like that. Uh, and I've had that. I've run into that actually. I've had um, clients that you know there's some sort of mistake or intentional sort of omission that's 10 to 20 million dollars, and they know about it, we know about it, but it's under our threshold. And so they're just okay with it. They're just like, now we'll just let it roll. We'll just let it, it'll sort itself out in the next quarter, right? And the company's making billions of dollars. Does it really matter? No. Am I still salty that that I had to spend like a whole day writing a memo about why we were mad about it, but also not doing anything about it? Yes. Yes, I am still salty that I had to do that. But such is the life that I've chosen, right? So the accountant for healthy life consult, so we'll skip this example. Basically, we've gone over a lot of the overstatement and understatement impacts of things like this. Once we create all of our adjusting journal entries, we create what's called the adjusted trial balance. And we verify the total amounts of debits and credits still match. And we have our additional accounts that we created and all of our ledger accounts, all of our T accounts, they're adjusted for the amounts uh, that we intended, right? And so yeah, that comes right from our T accounts, right? We had our 5 journal entries that we did in this example. Then we had all the ledger accounts. We posted each debit and credit to its particular account, and then the new totals are here. And we'll come back to this vertical analysis in just a moment. But this adjusting entries, how much time do we have? The adjusting entries from the trial balance, uh, we can take a look at the trial balance, and right, these are beginning and ending are both accurate here. And I apologize that it's so small on the screen here, but essentially we can take a look at each account and figure out what changed. So for example, accounts receivable went up by 6. So an accounts receivable adjusting entry is pretty much always going to go with revenue. So we know we can infer from the change in the trial balance from the unadjusted to the adjusted that there was an accounts receivable adjusting entry, debit 6, credit 6 to fees earned. And then supplies expense, right? We see supplies reduced by 2, and then supplies expense increased by 2. We can see that insurance expense increased from 0 to 12 and prepaid insurance decreased from 20 to 8. So we know that this was the journal entry that occurred. And then we also, we see depreciation expense increased from 0 to 4, and we see accumulated depreciation increased from 8 to 12. And so we know that there was 4 in depreciation expense. And we see wages expense. Wages expense went from 0 to 2, and then wages payable went from 0 to 2 as well. So we know that there was a wages expense accrual. And then in this example, this one is a little bit more messy. So we have our unadjusted trial balance, and it balances, everything looks good, everything's fine. And our adjusted trial balance, the numbers are a little bit off because there's a number of problems here. Things weren't posted correctly. For example, accounts receivable debited for $5,000, but there was no increase to revenue. So see, accounts receivable went up, but laundry revenue went from 182,000 to 182,000. There's no change there. So that was a mistake. The accountant debited rather than credited laundry supplies. So we see laundry supplies expense went from 0 to 3,000, but the laundry supplies went up when it really should have gone down. The accountant credited prepaid insurance for 3,600, but only debited insurance expense for 600. So that's another mistake here, right? We can see the activity where we know the insurance expense change and the prepaid insurance change. And then there was depreciation expense of $13,000, but accumulated depreciation didn't change, and the laundry equipment was debited incorrectly, right? Remember, we do not debit. So when we do our depreciation entries, this is super important. We debit depreciation expense and we credit accumulated depreciation. We do not credit laundry equipment. When we're depreciating laundry equipment, we credit accumulated depreciation laundry equipment, not laundry equipment itself. The laundry equipment account will remain at its historical cost until it is sold or otherwise disposed of. It will not decrease by depreciation. Only the net book value decreases. So now we'll get into some vertical analysis of financial statements. So, so vertical analysis is taking every item in the income statement and the balance sheet as a percentage of a total. So revenue in the income statement, everything is taken as a percentage of total revenue. On the balance sheet, everything is taken as a percentage of total assets. And it says in the liabilities and stockholders' equity section, it's taken as a percentage of total liabilities and stockholders' equity. Well, because of the accounting equation, total assets is equal to total liabilities and stockholders' equity. So everything on the balance sheet is taken as a percentage of total 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 assets. And so what this allows us to do is to compare it allows us to compare the same company within 2 years, and it also allows us to compare companies between each other. This example I think is really cool. So revenue increased. We looked at this example in a previous week where revenue increased by almost like 30% from 150 to 187,000. But this allows us to compare the margins and what contributed to the expenses for the year. So this is 2026, this is 2027. And so net income also increased, but margins actually decreased. And so the profit margin in this scenario would be 52.8% in year one, 50.7% in year two. And so the CEO or the CFO or whatever might look at this and say, okay, we increased our revenue by $37,000. We increased our profit by almost $16,000. But why did our margins decrease? Right? Like what actually quantitatively describe what contributed to that? And we're taking everything as a percentage of total revenue. So we can see that of the 2%, 2.1% decrease in profit margin, wages expense increased 2%. So that's a big component there is wages expense. Also, utilities expense increased by 0.7%. So that's 2.7% increase right there from wages expense and utilities, offset by a decrease in supplies expense of 0.6%. And that is so important and so relevant on earnings calls, on investor relations, media, and things like that, because that's the questions that the investment analysts are going to ask of the company. And so when the company is preparing the financial statements, they need to look at this and they need to know those things both to better manage the business, but also to better report there's what's called the management's discussion and analysis section of the financial statements. It says, what's management thinking when they're reading these financials? Because the CEO is looking at this stuff, right? The CFO is looking at this stuff. It's saying, okay, well, we're growing. That's great. But how do we control our costs as we grow so that we can maintain growth in our profit at the same time? Because eventually, if a company grows too fast, expenses can easily, outpace the additional revenues that are gained. And so, great year, right? Increase in profit of almost $16,000, like almost 20% increase in profit. But the margins slightly went down. And so they take that into their, looking to the future, forecasting what the future growth is going to be like and figuring out how to control costs that are going on in the future. So I want to look at this in a few real companies. Can anyone give me two competitors, same industry, big companies that we can look at their stuff, look at their financials? I don't know if Micro Center is public. Well, we can look at, basically we look up So it's still, microelectronics is still a private company, so we can't look at their stuff. Is there another, I don't know of any other competitors that would be really super relevant. What? Oh yeah. Yeah. Anybody have another industry to look at? Sure. Apple and Samsung probably. So if we look at, so what we look up is just Samsung. This is Samsung's investor relations page. If we go to 2024 full year and just take a look at the income statements. And this is also a really good example of why this stuff is useful because Samsung is a Korean company. They report their, well, so in the example here, they're reporting their income statement both in USD and Korean won. But if we were comparing Samsung and Korean won and a much different, not only are they a different size company, but they're also a different currency, allowing us to compare margins as a percentage makes analysis between the companies a lot easier. So if we go to annual filings, Apple's 10K, can just take a look at, see Apple's an EY client. And that's annoying. So if we take a look at this Apple's, if we just look at the Excel financials of Apple, we can figure out what their margins are pretty easily. Uh, basically what we do is we take everything divided by, and then we do like this. We click on it again, and then press, if you go like function F4, it puts the little dollar signs by it and it tracks it. We just show percentage. We can go all the way down and everything as a percentage here. And so we can see that Apple's total gross margin is 46.9%. And we can see Samsung, if we take, if we take 300, 870, divide, or if we take actually the gross profit of 114,308 divided by 300,870, that there, since Samsung's margin is 37%. And so we can compare between Apple and Samsung. We say, okay, Apple is selling its products at a higher margin. And then we got to consider, is this because of product mix? Because Samsung also sells like washing machines and stuff like that. Are washing machines a less profitable item to sell than an iPhone or a AirPods or something like that? And so there can be two there's two impacts to what changes different margins, right? Profitability of the individual products and product mix too. So then those are like the things to consider. It's like, okay, now we know that the profit margins are different. How do we dig into that? And you can dig into that in the notes or generally, the CEO or whatever is going to talk about why the difference is between the two. So that's really the advantage of vertical analysis. So that's all I have.